Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Thompson.
And me, Hartej, Singh.
The CIO Chair's guest today is Chetan Ghosh. Chet has been the Chief Investment Officer for Centrica's pension scheme arrangements within a common investment fund for over 15 years, now doing that role within Schroders Solutions through an OCIO arrangement. He is responsible for providing support to the directors of the investment committee, and his role covers investment strategy considerations, asset class and manager research, and liaising with the investment advisors. He has around 30 years industry experience, primarily from the consultancy side, where he spent 5 years as a pensions actuary and 10 years on the investment side, a large part of which was at Aon. Immediately before joining Centrica, he developed the fiduciary management offering at an asset manager, where he was able to gain valuable experience in improving investment decision-making governance structures. Welcome to the CIO Chair, Chet. It is a pleasure to have you here. I hope you are sitting comfortably.
Thanks, Sean. Lovely to be joining you both today.
So thanks, Chet. Shall we start with what's your title and what does your role look like on a day-to-day basis?
I have a lead role within our OCIO business here at Schroders. OCIO stands for Outsourced Chief Investment Officer. And effectively, it's a total solution outsourcing model that our clients and prospects can make use of. And that model encompasses both the setting of strategic asset allocation and then the smart implementation of that strategic asset allocation. And therefore, turning that into what does the day-to-day look like, it's a mixture of driving what the business proposition is, it's looking after existing clients, and it's thinking about new business as well.
That makes sense. So you obviously had a role as a CIO at Centrica. Could you give us your journey to that? Like, what were the skills you picked up along the way in order to land that sort of CIO role?
So starting out as a pensions actuary, working down in Croydon. I did that for 6 years, and then the world of GMP equalisation got a little bit too exciting, and I thought that was the time to make the switch over to investment consulting. I did that.
GMP, just for clarification?
Guaranteed minimum pension. So there was an underpin to people's pensions, and that was deemed to have been calculated incorrectly on the grounds of sex. There wasn't equality there. So there's a lot of big work streams that go on today, still 25 years later, about trying to amend that position. But yeah, then just moving on into the journey, again, moved over to investment consulting and did that for many years, primarily at Aon. That was a really good grounding in terms of getting that kind of base knowledge of the theory of investing. The pension experience came in really into its own during those early 2000s with the onset of liability-driven investing, which is shortened to LDI for UK pension schemes. So being able to understand both the investment and liability side was really important. So a bit of a lucky break in terms of timing. I then took a year out to go traveling, and I managed to come back at the time when we were entering the GFC. So luckily, I'd managed to get into employment, and that was with a multi-manager just before the worst bits of the GFC took effect. What I had there was a fabulous grounding in terms of pulling the trigger live on investing money, which I think is a really important complement to the theory you learn as an investment consultant. And I also got immersed in all facets of running the business, like new business, developing the proposition, client relationship management. So it really was formative for my career. And then I got approached for the Centrica role. And, it sounded an extremely exciting proposition, which it turned out to be. But I'd say, you had some big investment teams at that time in 2009, but the kind of the role of being a 1 or 2 person band was a little bit less well known at that stage. So a bit of a risk in terms of going into the unknown, but really has turned out to be extremely accretive to my experience and career. And then from 2005-9 onwards, I've been doing that role for the last 3 years. It's been done within Schroders.
Can you tell me about that transition from being an in-house CIO to an OCIO, and what are the key differences between those roles?
Yeah, so I think primarily the difference is environment. It's a different environment within which you work. The actual nuts and bolts of what you have to do to keep the scheme up and running on an investment basis are the same. It doesn't change having moved from one firm to another. The environment differences are quite stark. So when we were an in-house team within an energy company, we were the only experts on investing pension scheme money. So we were kind of almost left in our own cocoon. That has pros and cons. You know, you don't have as much peer-to-peer engagement intellectually. You just have it within the team. We were a team of 7. You don't have vast resources that you can rely on. But also, you know, flipping that round, you're more nimble and you are at the coalface, able to kind of unblock things faster. And then moving across, you know, it's pretty much the converse, but it's been really refreshing to have access to the vast resources that sit within an investment management firm. Business continuity is a much more readily handleable, it's something we can handle a lot more readily now. If we have a resignation, we have a whole pool of people we can tap into to get the next person in situ. Those are some of the major differences.
And I guess being in-house and the kind of being able to make an internal decision versus almost advising people and making that decision. Can you talk to me about how the governance works? It feels like how do you make sure that you can make the decisions that you need to make in the time that you need to make them?
Yes. So, I mean, every institutional investment pot of capital will have its own nuances on governance and how it's set up. I think the key things I would draw out is what's important is to work out where do you need to act nimbly and then how can you make that happen. So if I give you a few examples in my own experience when we've been doing this for Centrica, getting the right delegations to the in-house team so that they could just get on and execute on decisions that have been made. I think that was important. So, you know, just run-of-the-mill things like rebalancing, being able to get on with that, monitor it daily, enact on it daily if required. That's quite a big change to a lot of schemes that are just advised without having an in-house team. The rebalancing might wait till the next quarterly trustee meeting and then take a while for the consultant to execute. So you can be working, you know, on quite out-of-date information. And then I think the other thing that I'd highlight in terms of structuring the governance was we didn't feel that being beholden to quarterly investment meetings was necessarily the way that we had to operate. If there were things we needed to decide upon in between meetings, we set the governance up so that we were able to do so. And that was just as simple as being able to convene meetings ad hoc over the phone if required, if we couldn't do it in person, but making sure that that was all pre-planned so that, you know, it wasn't a surprise to anyone if something came in between quarters. So a couple of key examples of things that highlight how it's important to get the governance set up right.
Do you see the OCIO role as changing as we go forward with the pension scheme arrangement going forward? In terms of what I'm trying to get to, I suppose, is being a sort of jointly CIO and investment consulting business, do you see that evolving and actually more and more pension schemes and insurance firms looking at the OCIO arrangement as being something that they should take on board?
So, I mean, not surprisingly, Sean, the answer is yes from my perspective. And the reason I say that is if you go to any institutional asset owner and say, is absolutely everything perfect with your investment decision-making setup? I don't think I really get an answer where people say, yes, it's 100% where I want it to be. And so there's always something that can be improved in any setup. And not all of the time, but some of the time, that can lend itself to an OCIO firm actually being able to assist with improving the area that isn't as strong as the stakeholders might like. And we see that trend emerging all around the world. The surveys show the amount of assets that are under OCIO having doubled fairly quickly. It's in the low trillions. And it isn't a surprise. There is a lot of investment firepower in terms of research, in terms of strategic asset allocation advice that sits within firms like our own. And it's probably underutilized by a lot of institutional asset owners. So I'm a firm believer that there'll be a realization that actually there's a lot more that can be leveraged from this type of service, and therefore that will create the greater utilization.
That makes sense. How do you determine your time horizon? So obviously this is long dated investing. What do you consider your time horizon, and how do you measure performance, as well as how do you think about your strategic asset allocation in terms of your time horizon?
Yeah, I mean, the reality is the time horizon will differ for different types of investors. And I think a thing that doesn't get done enough is robustly testing how long that time horizon genuinely is. And I think within that testing, what people need to consider is, what about regime change? You've got a set of stakeholders who might buy into a philosophy today, but they will at some point no longer be there, and someone else will be in there, different ideas. And if they want to change the dynamics, could that actually interrupt what you thought your time horizon is? But if I then bring it back to UK pension schemes, they're in a slightly strange place where the last pension gets paid in 100 years' time when you model it out. So from that perspective, you've got a long-term time horizon, but they are marking their assets and liabilities to market daily. And they are really concerned about the changes in their deficit on a day in, day out basis, which really shortens the time horizon. The challenge that many of these schemes try to grapple with is, how can I be a long-term investor while I've got this short-term anchor? And we find different schemes interpret or solve that challenge in different ways. And quite often it's a function of how strong the sponsor is, how well funded they are. So it's a very nuanced thing that is idiosyncratic to every investor. I think then, in terms of how do you benchmark performance, typically pension schemes in the UK set a comparator versus gilts. So, for example, gilts plus 1 or gilts plus 1.5%, but they invest in assets that aren't gilts. Some of it's gilts, but there's a lot of assets that aren't gilts. So you're going to get a lot of deviation. So I think it is generally well understood that you need some sort of market cycle to appraise that. Although invariably we know how human nature works. There are people who will say, after one quarter, why am I off target? And that just needs to be managed. But it isn't the practical way that you can assess pension schemes.
Chet, how do you manage that? Because obviously that's one of the key things, isn't it? Is looking at your benchmark and seeing how you're performing and then making sometimes too quick a decision. How do you manage it at Schroders Solutions?
Yeah, so the key here is to really work on setting expectations up front, is to illustrate the examples of, hey, look, after one quarter, the equity market might be down 10%. This is what your returns might look like versus gilts plus a margin, and it's going to be negative. But then if you then looked at 5 years, you're going to have potentially a very different picture. That in itself is probably not enough. Unfortunately, if you think about stakeholders for any type of investor, if they're advisory boards, not just trustees for pension schemes, they need reminding. And it feels a little bit sheepish reminding pretty successful adults that they need to consider this over a longer time period. But I do find that without that reminding, you fall into a lot of wasted airtime going over the same point. So I think getting on the front foot and proactively reminding is key.
And that comes down to risk as well, right? So it's actually assessing how much risk any one of the investors might be prepared to take. And how do you look at that when discussing that with the underlying pension scheme clients that you have?
Yeah, so I mean, people in most of this industry default a risk number that is basically a mathematical standard deviation. And I would challenge nearly every stakeholder who is responsible for an institutional pot of money to actually say, to give me a bulletproof logic as to how they set that number. Because a standard deviation number is quite an abstract. And you can convert it into a value at risk. But I tend to find where people are not robust is saying why they could tolerate maybe a 200 million loss as opposed to 220 million loss. How did they draw the line? And I think that is really difficult. If we try to approach things that way, it's very, very difficult to document. I think we prefer also to then supplement that with scenario analysis and just say, look, if this happens and the worst case, your outcome is negative by X, is that something and these are the financial implications. Can you live with it?
Mm-hmm.
And I think you test it on a variety of things. So it's not just, is my assets 200 million lower? It could be, actually, your illiquidity has shot up. Can you deal with that? You lose optionality. Chances are your illiquidity shot up at a time you want to buy liquid markets because they're cheaper, but you're not able to do so. So I think it's working through that, which I think brings risk into a much more tangible concept than just looking at a standard deviation number.
So, given that, I guess the current ways of measuring risk have their flaws, and scenario analysis is one way to get there, how do you think about the scenarios you use? Because that would also impact then the asset classes that you would feel comfortable investing in.
Yeah, I think trying to be too precise here is probably a futile science, because people almost get comfort by, hey, there's a precise scenario that someone has deemed is the 95th percentile. And I think that kind of slightly loses the point. I think the key discipline for me is look at an adverse scenario. Don't try to define it as being right or wrong, but just don't spend your bandwidth trying to work out if that is the correct scenario to analyze. But take these extremes and see if you can live with the outcome. So just in terms of a personal preference, and that's not to say we don't still do this in our firm, but trying to second guess, different economic scenarios, like if we had deflation or if we have inflation or tariff wars re-escalate, and kind of second guess what asset classes might do relative to each other. I think that's a really hard science. I think it's just easy to say, what if my assets fell by 20%? Now let's look at, can I deal with it and what are the implications?
And looking at the actual asset classes that you're investing in, we were talking in the previous episode to USS Investment Management, and they were saying that they held approximately around 25% of their portfolio in private assets. Where do you sit with private assets, and how do you allocate that within the portfolios that you act on behalf of?
So for the majority of our client base, because they're smaller, we tend to not have much illiquidity. And what illiquidity there is, it's declining because they are getting closer and closer to their end game. And even if they haven't said they want to go to buyout, they want to retain the flexibility to change their minds to go to buyout. On the larger schemes, quite often that we've inherited through partnerships, they ran with more illiquidity than what you've said. Some of them have run with more illiquidity than what you highlighted for USS. And then as a result of the gilts crisis, that has gone even higher. So, upwards of 25%. But again, it's the same forces that apply to the rest of our book, which is these schemes are de-risking. They're on a trajectory to ultimately be buyout ready. And being buyout ready means not really having illiquid. So all of it's being run off for the UK pension scheme client base. When you've got other types of investors, then it's much more standard. And typically, it depends on what the objectives are. You're going to get different outcomes for insurance versus, say, a full octane growth sovereign wealth. But we tend to see, I say, if it's a full octane growth mandate, I think the level of illiquidity is like in and around 30-40% is quite often the number we'd see.
Do you think that a pension scheme going through a buyout, having to reduce the amount of monies they may hold in private assets. Does that actually work because they have to do it because they're being bought by an insurance firm who doesn't have the luxury of being able to hold as much money in private assets because of Solvency II? Is that fair?
I think it's just the terms of the trade, Sean. I mean, it's if people want that gold-plated insurance, it's what they have to do. I think the other thing to also remember here is the insurers do own a lot of private assets in their asset book. So, but they're just different. Now, I think that the question that the industry's asked several times is if you have assets that in theory are insurance friendly, could they not just be taken across? And so in theory, the answer is yes, but in live examples, I think there's very few cases where that has been the case. Sometimes you have managers who also offer buyout saying, hey, well, come and invest with us. And the private assets we buy for you will guarantee that we take them across. There are a few schemes that do that, but that's not really, it doesn't have mass prevalence.
And so what options are available to pension funds? You've talked about buyout. Is that the only option, or is that what everyone's working to, or are there other options?
Yeah, so there's last few years, there's been a lot more increased talk of run on. And I think there are a few flavors of this, and I define it as run on and run off. So run on is running the assets on fairly conservatively, but trying to generate some sort of additional buffer or surplus that can be utilized by one stakeholder group or one or more stakeholders groups. So it could be the company that take a refund of surplus ultimately. It could be the pension scheme members getting discretionary uplifts. So there's been a lot of talk about that, and that's also linked in quite heavily to what the government are trying to do in terms of policy changes that they are introducing. You then also have runoff where you just run it really conservatively. You don't try and get any more extra return than you need to pay the last pension, but you're not looking to generate a surplus there. It's basically, I just don't want to pay the insurance premium. Those are the two main options. And I think you are going to get a segment of the UK pension scheme population that don't go to buyout. As one example, those with American parents going to buyout becomes quite a severe accounting hit, and that becomes quite unattractive to many. You might have a strong financial institution that takes a view that they don't want to pass the profit over to the insurers. They'd rather keep it for themselves. So I think there will be a few cases where people carry on without going to buyout. But what will be interesting is how many thought they were going to buy out, but now choose to carry on. And that's, we don't really have too many statistics on that yet because of the conversation has reignited relatively recently.
That makes sense. I had one question. We've talked about long time horizons and risk taking. What's your thoughts around tactical asset allocation? Do you think there's a role for taking shorter term tilts within this longer term strategy?
So I think this also intertwines a little bit of my own personal investment philosophy, and the kind of a big element of it is work out as an investor what your USPs are and play to those. So if you're a pension scheme, if you're an endowment, if you're a sovereign wealth fund, and you want to play tactical asset allocation, you're up against some of the best minds in hedge funds. Are you really better than them? And actually, are they doing it that well? Where I am more inclined to make use of these kind of adjustments is when it comes to risk management. Are you putting an undue amount of risk exposure into your schemes for a certain reason? Because markets have moved. Markets have rallied, I think, 20%, maybe plus, since early April. And we know the concentration of the Magnificent Seven. So you might say, I'm running more equity exposure than feels comfortable. I'm just going to take that down. That's understandable. The difficulty is if the market continues to go up, how your stakeholders react to that. And that becomes really difficult to get the stakeholders to remain committed to decisions that don't go the right way, even though it's done for sensible risk management reasons. And I think this is one of the hardest things in investment, that I think there are a lot of decisions that can be sensibly made for risk management reasons, that people worry about career risk in doing so. So that dynamic, I think, pervades so much of how the investing world works.
Can you talk more about that? So what do you think are the decisions that people will take to protect their careers that might be suboptimal for a portfolio?
I mean, I think I've just given an example that people might say, I don't want 70% of my equities in the US stock market, and I certainly don't want 20 or 30% of them in the Magnificent Seven. And therefore, they reduce that weighting. But it's the degree of reduction that I think then verges into career risk territory. So if you were to say, rather than 70% in the US, I'm only going to have 50%. And, it wasn't too long ago, maybe 40 years or 30, 40 years ago, Japan was 50% or 50% plus of the stock market and absolutely kind of got wiped out. So, idiosyncratic country risk to a global leader can happen. So I think it's the degree of taking decisions do get impinged by career risk management to some degree. And I think that's understandable. I don't have anything against it. It's very clear why it happens, but that is something that could get in the way of sensible decision making. So it's a human emotion that I don't think you can take out of the system. It will always exist. And even if you manage to train your stakeholders to be comfortable with the type of risk management that you're doing, come back to regime change. The next set might not. They might just look at the black and white numbers of how you've done versus performance. And what doesn't get shown is how you've sought to manage risk. So I have a phrase that I like to use, which is you have to own the risk path that you choose to tread, but that's really difficult to get stakeholders to live that through on a multiple year basis.
So I think that leads quite nicely into responsible investing. Where do you see that within, not just at Schroders Solutions, but also the work that you do with your clients? And, are there sort of varying opinions on how pension schemes are looking at responsible investing and investing responsibly within their portfolios?
Yeah, I mean, there is a full spectrum of views amongst clients. I think certainly within Europe, for any asset owner, these types of considerations have to be taken with a good amount of seriousness. So we, under our fiduciary duty, we have to walk our clients through these considerations. I think in terms of, some myths that maybe exist, this view that the asset management industry weren't doing their fiduciary duty before ESG became mainstream and ignoring risks, I think doesn't wash for me. If you ignore risks, it damages your potential outcomes. So money managers will always be thinking about how to avoid risks. What probably got underplayed, and I think this is entirely fair, is the maybe longer term risk of climate change. But it's a real abstract to deal with because it's a multi-year risk and you don't quite know when it's going to come through. And the reality is a lot of equity pricing relates to the near term in terms of what's forecastable. So that's a difficult one, but it was probably something that the whole ESG movement has been really positive in terms of making sure that that is no longer a miss by the asset management industry. But that was probably the only thing in my mind that needed correcting. We've spent a vast amount of energy and resources across the investment industry on this area, probably for at least 7-8 years. My own personal view is we've not achieved too much in terms of getting fundamental change within companies. I have personal hobby horses about why plastic bags from retailers still exist, why hotels are still changing as umpteen million towels every day. I don't think our engagement has actually tackled really tangible things that could have changed with all of the hours that we have spent on this subject.
So do you think the engagement has been like effectively not coordinated enough, not clear enough, or do you think actually for some people engagement is something they feel they need to do rather than actually have the courage to then make the portfolio actions on the back if their engagement is not being met with?
Yeah, I mean, I definitely agree with the not coordinated enough. I think it probably for me comes down to a more simple point, is no one really set out with clarity of purpose. It was almost, hey, I'm under a pressure here to demonstrate I'm doing ESG stuff, but no one took the step back and said, What do I want to achieve by doing it? What differences do I want to make? And I think it was a really simple step. But because that simple step's not been taken, we've got thousands of hours that have not been particularly productive in terms of what has been invested by the asset management industry, which is a shame because we have invested a lot of time, which is good. It would be nice to have made much more substantive changes than we have.
So, Chet, just thinking about the UK in particular at this moment in time, what role do you see the UK playing a part in the portfolios that you manage, and in particular, the way in which you might be investing within the UK and the infrastructure, etc.?
So for our UK corporate defined benefit clients, it should be remembered that we are significant holders of UK government bonds. So we contribute massively to the spending and growth agenda of the UK government. And I think with all the Mansion House conversations that have gone on, that's been a quite understated point, that there's a lot of investment in the UK already. On average, you've probably got 50% allocation to UK government bonds within these portfolios. And then if we go back to the de-risking point, with the move to reducing illiquidity, very few are making allocations to liquid assets. And the types of things that are being discussed, like infrastructure, venture capital, are illiquid. And so in terms of that ambition to be buyout ready, it's not consistent. So I can't see really any material kind of new funds going to those spaces from this pool of capital. That said, you absolutely can see that the local authority, the LGPS pools and DC Master Trusts are going to be investors to some extent in those UK assets. And it makes sense for a lot of those investors, and things like, helping with the renewable rollout, with the onset of decumulation for DC, that stable income could be a very sensible asset as part of, the overall decumulation strategies. I think you're more going to see it there. And the other final nuance is, if they were to free up the legislation so that UK defined benefit schemes could actually invest for growth and not have to de-risk, they would then become sellers of their gilts of the government bonds. And I'm not sure that is an outcome the UK government would necessarily want.
As a follow-up, do you think the stance of the pension schemes is to have more in the UK and that, i.e., they'd like to do more? Or do you think they're sort of, because of their de-risking agenda, it's going to be directing them towards the government bonds rather than, let's say, building out UK infrastructure?
It's the primary consideration. It is the de-risking agenda, and that will naturally gravitate them to government bonds. I mean, it is interesting that we are now seeing more of an argument being made about trying to consider the future state of the country, the lifestyle that the pensioner population will get to live in, as a consideration. It's quite interesting to see the emergence of that school of thought, but I think it still will not be sufficient an argument to change how these defined benefit schemes in the UK are just heading towards buyout predominantly.
Chet, just thinking about your firm and how you manage monies and the way in which you do so, how do you ensure the firm's values and culture align with your investment strategies and decision-making processes? How do you bring that all together?
So, I mean, I think at the highest level, everyone has an obligation to adhere to those values and maintain the culture. So that is kind of an overarching feature of just being an employee of the firm. I think then if you layer it into kind of going downwards, when investment philosophies and processes are being built, these need to be demonstrated to be consistent with what the firm's values are. You're just not going to be allowed to have an investment approach that isn't consistent. So I think it just feeds through naturally that way. And this is a client business. So it's almost business suicide to do something that would be against the core values, which is all about trying to serve clients first.
And can you share a pivotal learning moment in your career that had a lasting impact on how you lead today and the way in which you work within Schroders Solutions?
Yeah, I mean, I think I'll probably give you two. I think one's more a pivotal moment, and it goes back to some of the governance points we discussed earlier. It was the build up to COVID, and it's not that we foresaw COVID happening, but it was late in the market cycle. And we, just to manage risk, we took a view that we needed to build up a cash holding in case the markets sell off. And that's quite a difficult thing to emotionally get your stakeholders to not just sign up to, but then run with as cash is becoming a drag. But we did all of the kind of pre-preparation, lots and lots of education about what would we do if the markets then subsequently sold off. And we also put in shell investment management agreements with the types of investments that we would want to make if the market sold up. So we were completely ready. We'd done all the pre-preparation. And then not knowing COVID was happening, but having a market sell-off, we literally convened almost within days of the market falling off a cliff, got the agreement to redeploy all of that money, got it invested quickly, and really not just managed the risk of the situation, but generated a lot of additional return. So a pivotal moment in terms of probably a lifetime of work of learning governance, getting governance set up right, getting the right behavioral reactions to when markets move, and keeping the emotional aspect in check. Because it's quite difficult. It seems easy to say it now. It's quite difficult when the world is in a dark place to be bold. But again, linking it into an early question, it was very much the education had been around the time horizon. I think that in terms of a learning, which I won't expand on as much, I think it was when I was at the multi-manager, and it was learning the difference between the theory of setting asset allocation and the reality of pressing the button to invest money. And it's very different, because suddenly you can lose, multiples, multiple millions, et cetera, and it sharpens you. And I think it was having that experience layered onto investment consulting that really helped me to kind of carry out my role at Centrica successfully.
And what do you think the role of processes are? So I guess we've talked about governance. We've talked about how, for example, I guess, fortunately, but also through great preparation, you had cash and shell IMAs in which to deploy during COVID. Are there any situations where processes aren't appropriate and it is intuition that is required in that moment?
Yeah, I mean, let's just explore why do we need processes? It's because the amount of data that you have to process is large, and therefore you need a way of dealing systematically with things. And that's why you put a process in place. Where I'm wary is if basically you have so many processes, you insist on, processes to the nth degree, and effectively you create a structure that is governance on steroids. In those situations, you'll find the governance weighs you down, and you're not focused on being able to do the investing that you want. So I'd probably make the first point that getting the right balance between the amount that process soak up in terms of bandwidth and allowing you to still make the right investment decisions on a timely basis, getting that balance right is key. And the thing that's difficult there is very often there's a requirement to cover oneself, or that's not necessarily an investment team, it could be the stakeholders, and they want those protections to feel comfortable. But there comes a point when that can get in the way of optimal investment decision making. All of that said, you do need processes because you need a systematic way to deal with things, but it just needs that balance.
Let's say you're in a situation where you believe the process that has been defined is being correctly followed, but intuitively the outcome feels perverse or at least suboptimal. How do you call that out in a way that doesn't make you sound renegade?
Yeah, no, it's not easy, right? And I think part of that is you shouldn't underestimate the amount of time you have to invest in your stakeholders to get that level of trust. That's really important, because then if you want to say, hey, I'm not corrupting the process, I just think the process is missing an aspect, they're much more likely to hear you positively rather than just seeing it as someone's trying to corrupt the process. And if I give you a live example, I think the LDI considerations, the liability-driven investing considerations, were a classic example of this, where the process was saying adding derivatives to buy gilts is riskless. And we weren't alone, but within the investment team, we were making the point that it uses leverage. And once you lose leverage, that comes with risk. The risks aren't stuff that you can quantify to your standard deviation number. They're qualitative risks that could happen that you can describe. And so having that position of trust, it was easier to make that point to the stakeholders. And we did see the gilts crisis happen when people thought leverage wasn't an issue. And it was pleasing that our stakeholders on the Centrica side had understood the concept of what whipsaw could be. They knew in advance. So I'd explain that to them. So I absolutely agree with the point that you can't be 100% driven by process. But I think in order to manage stakeholders, to go off piste with process, earning the trust is important.
So, Chet, one of the purposes of the CIO chair is really to sort of get to understand directly from CIOs at asset management firms and also asset owners about their advice that they might give to someone early in their investment career, or even if they're a current CIO and just wanted to learn more from others in the industry. What would be your advice? What would you give to someone who's looking at this as an investment career?
Yeah, so there are a few things. I think they're just behavioral attributes. I think there's no substitute for hard work. This is an industry full of super bright minds, all trying to gain an edge on each other. There is no substitute for hard work and just constantly being inquisitive. It's that kind of lends into the second point for me, which is question everything you're told and try to deconstruct it and question it from first principles yourself. I think these are really important things if you want to be someone that kind of makes the difference rather than is just a foot soldier.
Is there something that you look for when you're constructing teams that, let's say, you look out for more than, let's say, you think other people might?
I wouldn't quite categorize it like that. I think for me, recruiting is hard. We're competing with others to try and get the best minds. And the moment you grow larger, the ability to keep a team that has an average intellect higher than the competitors gets harder and harder. And that to me is a key component of retaining edge, is just having a quality differential versus what your competitors might have or other investment teams. So, when I was within Centrica, we just simply didn't compromise on the quality of people that we hired. Probably easier when you're 7, but it was hard because we were a team based in Windsor and it felt like Windsor was quite unfashionable for investment professionals. I think then trying to make sure that people have different viewpoints is really important. It can't be underestimated, but marrying that together with then keeping harmony within the team isn't as straightforward as you might think. People always say, hey, we all want diversity of thought, but that comes with challenges of keeping the team together. So those are probably the things that I'd look for. The direct answer to your question, but key considerations that I've had to make in the past.
So how do you bring diverse viewpoints and almost create the crucible that allows that challenge without it getting personal?
Yeah, so I think a lot of it is in terms of how you set the engagement up. So almost the process, making sure that people are not having direct conversations, trying to undermine each other and running the risk that they wind each other up, having it in collective committee forums, making sure everyone's got a chance to speak, making sure you chair these meetings strongly so that no one feels like they can't make a contribution, but they also are fair in terms of listening to the contributions to others. And I think you just got to be firm on that. And I think, unsurprisingly, you have to demonstrate the right type of leadership in order to get the best out of the diverse opinions of your team.
So we're coming to the end of our discussion, Chad, which has actually been very interesting, very informative, and we appreciate you sharing your insights with us. One final question from me would be, so what would you want your legacy as a CIO to be, and what would it look like?
Yeah, I think it's as simple as I'd like to be remembered as having been an investment force for good. I think working particularly with UK pensions, having been responsible for positive outcomes for thousands of pensioners in their retirement is something that feels virtuous. I know there's a lot of negativity to the investment industry, but at least I can say I've worked in a segment of it that feels a lot more virtuous than some of the other parts. So I think for me, that's really the thing that I will take away when I hang my boots up one day.
Brilliant, brilliant. So we end, as always, with a quick fire question round. Favourite sport, Chet?
Has to be football.
What team do you support?
Liverpool.
So do we.
Well done.
So we'll probably get a lot of listeners tuning off by now. Favourite film or TV drama?
My favourite film is probably The Usual Suspects. Yeah.
Great
Doesn't
film.
get mentioned enough, I think, but I think it's an absolute classic. Perfection.
Yeah. Perfect. Favourite drink?
Oh, this is boring. Water.
No, there's nothing boring with that. Water's very good for you. Favourite book?
I think from a finance perspective, it was The Wall Street Crash by John Kenneth Galbraith. I think it's really instrumental in understanding what can go wrong with using leverage, and also the epitome of highlighting how investor greed can lead to their own downfalls. If outside of finance, I don't know if book per se, but Oscar Wilde's played the importance of being earnest. I think absolutely amazing.
I did that for A level, and it is amazing. Favourite hobby? Last question. Favourite hobby?
Traveling, but also not sure it's classified as a hobby, but spending time looking after my daughter.
Brilliant. Perfect. Chet, it's been an absolute pleasure. Thank you so much for joining the CIO Chair today, and we look forward to speaking to you again soon.